Iconic Kellogg's is spinning off into two separate companies, and currently the company looks reasonably valued. Does this mean that investors should invest in Kellogg, expecting the spin-off later this year? Hello everybody, this is Chuck Carnevale, co-founder of Fast Graphs, the fundamentals analyzer software tool, a.k.a. Mr. Valuation. Today's video is going to be kind of one that I'm going to kill a couple of birds with one stone, if you will. I'm going to take a look at Kellogg historically and how the company has performed as an operating business in its current configuration. Then we're going to talk a little bit about what the company might look like after its spinoff. But the second bird I'm going to talk about valuation as it relates to a company that is not really a fast-growing stock like Kellogg's. So, I'm hoping to teach some lessons on valuation as well as taking an analytical look at Kellogg. So let's go ahead and get into the video. Let's start by taking a look at Kellogg's in the fast graph historically, going on our max time frame. This goes back to the beginning of 2003, and this company has a December fiscal year. And what I first want you to notice is the company has consistently generated earnings. I'm going to take the price off the graph temporarily here because I want you to look at the business of Kellogg. It's had some good growth years here. The change per year number really helps you evaluate what kind of growth the business has. But I want you to notice as I move my cursor along this time frame, the growth of Kellogg's has slowed down. So let's start cutting some time frames off of this graph. And now from, the 4% prior, we now have a 3% growth rate. Let's cut it down to 15 years. And now we have a 2% growth rate. And by the way, the 15 years includes, 2.25 years or so of forecast. Let's drop that down to 10 years. And now we still say around 2.51%. And let's go to 5 years, which includes about half forecast, half past, and we see about a 2% growth rate. Okay, so the main point here I want to get across is that Kellogg's typical 4% growth has really slowed down over these more recent years. And that's very, very important. I think that is part of what has instigated this company to do these spinoffs, which we'll talk about in a moment. From a dividend perspective, you can see Kellogg has been paying out around half of their earnings in income. Their payout ratios in the 40 and high 40s and mid 50% range, depending on whether earnings are going down like they did here, from 2014 to 15 and again here coming into COVID. Now, what's interesting about a company like Kellogg, and one of the reasons why people like these consumer staple stocks is because they tend to be very predictable. They don't grow very fast, as I think I've illustrated so far, but they tend to be very predictable. Note that the company actually performed very well during the financial recession we had in 2008 and into 2009. Also notice that the company did pretty well during COVID, which is the gray bar here. And the company did maintain their dividend. So one of the things that attract people to stocks like Kellogg is the stability of the company, not necessarily the growth rate. Now, from a standpoint of current fundamentals, the company trades at a current blended PE ratio of 14.63. This is not trailing 12 months, and this is not based on GAAP earnings. This is based on adjusted operating earnings, because I always get that question. The earnings yield is 6.83%, which is above the 6.67 to 7% or 6.67% minimum threshold that I like. So it looks fairly valued. And the dividend is approaching 4%, 3.93%. Now, historically, a growth rate like this would calculate out at a 15 PE ratio. That would be the orange line on this graph. However, if I put the normal PE ratio, which is a trimmed average of how the market has generally valued the stock, we get a higher PE. Now, that could be it's a blue chip, BBB rated, 49% debt, iconic company that has consistently performed through good and bad economies, not markets, but economies. But now when I put the weekly closing stock prices on the graph, you kind of get a clearer picture of valuation. Now, the market has had a penchant to put even higher valuations than the 17 times earnings on Kellogg's. Coming into the Great Recession, it did get down to about 12 times earnings. But you can see there are periods of time where the market puts 20 multiples. And remember, this blue line is 17. So that's kind of an average. This is a valuation reference line. There are lots of times where the market prices Kellogg's above that 17. Lots of times where they've priced it below that 17, especially more recently. Okay, but there is a quality premium. Now, here's one of the things that I want you to get a picture of. If I look at performance, Okay, and I'm going to go into the performance graph now. And I look at the performance compared to the S&P 500, which would be the benchmark for the average company. It has, over the long run, produced more dividend income than the market, but it's underperformed the market dramatically on a capital appreciation potential when I look at the maximum time frame I have. If I drop that to 20 years, I get similar. I get underperforming on total return, outperforming on terms of dividend income. So it's a dividend income paying stock. If I drop this now down to 15 years, I once again get underperformance on total return. I get not quite as good a performance or increase in income as you had compared to the S&P. I drop this down to 10 years. We have a significant underperformance against the market. We actually have a negative, rate of return in terms of capital appreciation. $10,000 turned into $8,000. That's a minus 2.18% over this time frame. And only because of dividends that we even eke out any rate of return at all. Okay, and then finally I'll go into the 5-year number here, which is actually only 3 years of history. And once again, you see this great underperformance. But here is the point that I want to make. As I've gone through all these performance records, it's not just enough to know how the company has performed relative to the market. I want you to know why it's underperformed the market. Now, first of all, in the maximum time frame, the first one we looked at, where Kellogg's, underperformed the market and only generated a 5% rate of return, and that includes dividend income. Capital appreciation growth, was 76%. In other words, it did turn 10,000 into 17,000. So compared to a bond, that would still look good. But the bottom line is, we didn't get a very high rate of return as relative to the company's growth rate, but the stock was moderately overvalued, even above its historical normal 17 PE, and now it's coming into fair value or even slightly below fair value. Okay, so why it underperformed? Because it didn't grow very fast and it started the period overvalued. When I drop it down to the 20 years, I see a very similar situation. It was overvalued, and now it's undervalued. The growth was only 3%. When I drop it down to the 15 years that I showed you, we see once again a little better valuation, but undervaluation. And once again, the growth rate had slowed down to 2%. So if I just, do a quick using the calculator function here, I ended up with a 4% rate of return. 10,000 did grow a little bit to 11,945. It did pay me a little dividend, so I ended up getting $17,000 out of a $10,000 investment, but that only equaled a 4.28% rate of return. And if I go to the 10-year, once again, we see the valuation was very high here, and it's getting to be undervalued here. The growth rate was 2%. There's where we only got that 1% rate of return. Now, here's where the lessons in valuation come into effect. Obviously, this company, because of its moderate and modest growth rates, doesn't generate very high rates of return. But I also want to point something else out. Valuation matters, and it matters a lot. There are times, I think because of the quality characteristics, where the market gets, I'm going to use the word irrationally exuberant. I'm not going to pick a perfect top here, but I'm going to pick a very high valuation when the market had a PE ratio of 21.56. Remember, currently the blended PE is 14.6. If you'd have bought Kellogg's at that point in time with low growth, you'd have actually lost money. You'd have lost just about 0.25% a year, but your $10,000 would have turned into $7,800. You'd have received $2,000 in dividends, and your $10,000 would have given you a return of $9,824, including dividend income. So valuation matters a lot. But on the other hand, even during low growth periods of time, if we'd have bought it somewhere coming out of the recession, not at the perfect bottom, and held it till it went to fair value, you could have now generated a 7.61% rate of return. If you bought it like that, and measured it on the peak valuation, you might have got up to 12.7%. Now, all of this is the effective valuation. There still wasn't much growth here, 7%, 3%, 2%, 0, a good year at 12%, then followed by 1%, minus 7%. So we had very flat growth during this period of time, but we got a 12.7% rate of return because we bought the stock when it was undervalued, and we measured it to when it was at peak valuation. But my point is, you don't ever want to pay a high valuation for a slow grower like Kellogg's, in my opinion. If you're buying the stock at reasonable or low valuations, you can eke out rates of return, but I want your expectations to be realistic. this is not going to generate a great deal of money for you. It's going to be very stable. It's going to give you a decent amount of income, maybe a little bit of inflation hedging, but it's not going to be a 10-bagger like Peter Lynch talks. Now, there are times where you could trade this stock, as I pointed out, where if you get an opportunity to buy it at a really low valuation and trade it to a high valuation, you could find short periods of time, if you were a day trader, where you could make very high rates of return. But the point is that looks good in hindsight, but it's very hard to determine that in foresight. Now, right now, Kellogg's has sold off like most of these consumer staples have, so it looks fairly valuable. But let's look at the forecasting calculators now. And these forecasting calculators are pre the split. The spinoff isn't going to happen until the fourth quarter of this year. But even then, analysts, and there are 15 analysts following this company for these next 2 years, are only expecting about 3% growth going forward. So that would imply a 14.7 PE ratio, which is what the orange line is. We're using the Graham-Dodd formula. That's what GDF stands for. That would give you a possibility of making about 7.3%. If you went to the normal multiple over this period of time of about 16, that could increase it up to an 11.68%. Okay, now the long-term growth rate expectation for Kellogg's is only expected to be 2.5. Now I want to check another source. Let's check Yahoo, which uses Reuters. I've given you FactSet data here, and Reuters says the next 5 years is going to be 2.9%. So that's reasonably consistent with what FastGraphs is showing, getting their data from FactSet, okay, FactSet Research Systems, Inc. All right, so analysts don't expect very much. Now, what the company has done, and I do want to talk about this a little bit, obviously you got to be very careful with valuation with a slow growth company like this, as I've already indicated. The company is trying to unleash some of their growth. So let's look at their two new companies. It's called Kellanova, which will be the primary company, and W.K. Kellogg, which is the cereal company. Kellanova will be the snack food company. All right. And if we look at these companies from a standpoint of what they're going to be, the Kellanova will still be the big company. This will still have the symbol K. It'll be the original Kellogg's with about $13.5 billion in market cap, and then the new company WK, the spin-off company WK Kellogg, will have about $2.7 billion in revenues, and you will get both of those stocks. Okay. Now, what Kellogg's expects to be able to do from that is they do expect to unleash value there. And, the company is talking about getting much higher sales. So I put together some information here that I've gleaned from other sources just to share with you. And this is from Zacks. Now, Kellanova's portfolio will be more focused on snacks and emerging markets, including differentiated brands with a robust scope for expansion. It'll be companies like Cheez-Its, Rice Krispies, etc. Kellanova's net sales are going to be about 12 to 13 billion, and WK Kellogg will be the $2.7 billion company focused primarily on the cereal brands in U.S. and Canada primarily. Okay, now what Kellogg's is indicating that they're going to do here, they claim that they could earn a higher valuation closer to its peers like Mondelez International after separating from Kellogg's North American cereal business. So in other words, Kellanova, they think, can have a higher growth rate, and it's roughly 82% of sales. Now, they've been working, towards this, and again, they're going to be doing this in the future. This is Kellogg speaking now. They believe the spinoffs will position each business to unlock its full potential. Now, the question is, as an investor, are you, down with that? Now, if I look at, Zacks has the company on a hold right now, and Zacks talks about reasons, to buy the stock, and they say, the company has improved their results lately. They've raised sales and profit view. In line with the strategy to diversify its organic offerings, Kellogg's acquired protein bar maker Chicago Bar Company in 2017. They have a strong brand portfolio, etc. But reasons to sell would include high SG&A costs, and they've been seeing the adverse effects of high inflation, which is obviously affecting a lot of industries. Currency headwinds are something they have to deal with, and food industry headwinds. Okay, so, Zacks has it as a hold. If I went into Morningstar real quick, Morningstar does give it a fair value of about $84 a share, and they call that to maintain their $84 sum of the parts valuation to the combined firm. And, they talk about what multiples they apply, but the point is they don't think the spinoff paves the way for sweeter business prospects. So that's something to take into consideration. Anyway, the bottom line here is this company has been a great dividend payer. Operating cash flow has at times, fallen below the dividend, and free cash flow has at times fallen below the dividend on more than one occasion. But all in all, this company has been able to maintain their business. Their price to EBITDA has normally been around 9 times EBITDA. They're currently trading at a price to EBITDA of 8.74. So that would indicate a slight undervaluation based on EBITDA. And then finally, looking at the company's sales growth has averaged about 3.9%. But as I shorten the time frame, it's slowed down to about 2.54%. Forecast growth is expected to remain at around 2.54%. All right, and long-term growth is expected to be about 2.5%. This is sales now. So all in all, I think if you're really looking at this company from the standpoint of a long-term investment, its attraction is a reasonably high dividend yield, which is almost 4%, real stability across even bad economic times, but it's more bond-like than it is stock-like. Anyway, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. I hope you enjoyed this video, and I hope you got some benefit out of some of my valuation principles that I'm talking about here. With slow growth companies like Kellogg, you got to be careful of the price or value that you pay to buy the stock, the multiple of earnings, multiple of cash flows, multiple of EBITDA, et cetera. You always want to try to get these stocks at a bargain if you're going to get any, real rate of return out of them at all. Now, as far as Kellogg's future, the spinoff is going to happen in the fourth quarter. I personally am waiting to even look at the spinoffs. This isn't a company that attracts me very much for a lot of the reasons I discussed here in the video, but it is a stable company, it is a blue chip, and it does have, its merits as I've, presented throughout this video. If you like this video, give me a like, ring the bell, subscribe to the channel, and look at FastGraphs. Look what a marvelous tool it is that can help you research stocks deeper, faster, and more effectively so that you can make better buy, sell, and hold decisions, and most importantly, so that you have a clear expectation of what any investment in any company is likely to bring you. Hope you enjoyed this video. I am going to do a bonus part 4, if you will, because I've had a lot of requests for some of the other companies. It's going to be a high-level video, but that'll be coming next. Anyway, thanks for watching, and I'll be talking to you again very soon.